Hello there! Welcome to What is the Matter, where we discuss money matter. In my previous videos, yours sincerely, me, Mr. Huat, is the matter, promised to share how I personally use a strategy to enhance my returns on exchange-traded funds. Today, I will show you what I do. Please note that this is never a recommendation to anyone. I am only sharing for entertainment purposes on what I have done for my own portfolio. Okay, huh? So what are options? Options are financial contracts that give the buyer the right, but not the obligation, to buy or sell an underlying asset at a predetermined price, the strike price, within a specified time frame. Options might be attractive to investors who prefer an active investment approach, especially since they would need to constantly monitor the underlying asset's performance. Ultimately, it all depends on one's individual investing style. With that said, let me share a strategy which I use to generate passive income. It is known as the wheel option strategy. To explain how it works, understand that an option contract is 100 shares of an underlying asset. First, I sell a cash-secured put, where I need to put up sufficient cash as collateral to cover these 100 shares. I repeat this until I get assigned to buy the 100 shares. I will then sell covered calls on my 100 shares as collateral. Finally, I repeat this entire process, like a wheel. What I want to achieve is the sweet premiums every time I sell options using the wheel strategy. I can also potentially buy or sell the underlying asset I want, at good prices. For both strategies, I'll ideally hope for the contract to expire worthless for the buyer, but I'll always be prepared for having the contract to be exercised against my favor. Take note that for both strategies, if the current share price is very far away from the strike price I choose, the premium I get will be lower too, as the risk will be lower. Now, for the first half of the strategy, what is cash-secured put? For cash-secured put, I'll be selling a put contract on an underlying asset. I'll need to have enough cash as collateral to purchase 100 shares of the asset if this contract is exercised. As the seller of the put contract, what I'm offering is that I must buy 100 shares of this asset from the buyer of the contract at a specified price, strike price, and at any time on or before a specified date, expiration date. My objective is to collect the premiums that I receive immediately upon the buyer fulfilling my contract, and for the contract to expire worthless for the buyer, so that I would not need to sacrifice my collateral to buy 100 shares. I use the cash-secured put when I anticipate the share price to increase or when I have a bullish outlook on the market. The pros of the cash-secured put are: 1. I will collect premiums no matter if the option goes against my favor and gets exercised. 2. If I think the stock is currently overpriced, I can choose a strike price to purchase 100 shares at a discount to reduce my cost basis. The cons are: 1. I'm obligated to purchase 100 shares at the strike price if the contract expires in the money for the buyer, which means that the share price drops below strike price. This means that I will suffer an immediate capital loss. What's more worrying is if the share price drops to zero or the company goes bankrupt, as I would potentially lose all my capital since I must still buy the 100 shares at strike price. 2. I require a lot of capital as collateral to purchase 100 shares. 3. Since I do not own any shares, I do not receive any dividends. Moving on, what goes through my mind when I place a cash-secured put? First, I will select a stock with strong fundamentals that I would like to own. This is a win-win for me. I will earn a premium while also potentially acquiring 100 shares of the stock if I were to be assigned. Second, I select a strike price below my current cost basis to reduce my overall cost basis. Cost basis is the per-share cost. Third, I will look at the technical side of the trade, also known as options Greek. I will focus on delta to help me choose which contract to sell. Most investors look at a delta of negative 0.3 or lower since the risk-reward ratio is the greatest. Delta can be understood as follows. A delta of negative 0.3 or lower suggests that the buyer has a 30% probability of the option expiring in the money and a 70% chance of it expiring worthless for them. Fourth, I will consider the expiration date of my options contract. The most common period investors use is from 30 to 45 days to expiry DTE, since the time decay risk-reward is the greatest. Using a real example, let's assume on the 20th of March 2024, I sell a cash-secured put, SPDR S&P 500 ETF Trust SPY, with the following terms. The following parameters of this cash-secured put are a strike price of $508, a delta of negative 0.298, which means a 71% chance of this cash-secured put expiring worthless for the buyer. The expiration date is the 19th of April 2024, with 30 days to expiry from the 20th of March 2024. Two outcomes can happen. The first outcome: contract expires out of the money for the buyer if SPY stays above $508. The buyer would not exercise their right to sell SPY at $508 since they can sell it at a higher price on the open market. The contract expires worthless, and I get to keep my money and the premium. I will repeat this process. The second outcome: contract expires in the money for the buyer if SPY drops below $508. The buyer would want to exercise their right to sell SPY at a higher price than what is in the market. My put option is assigned. I am obligated to buy 100 shares of SPY from the buyer at the strike price of $508 using my cash collateral. I still get to keep the premium. Let's say the second outcome happens. I have 100 shares of the stock. What do? This is where the second half of the strategy, covered call, comes into play. Covered call is essentially the opposite of the cash-secured put. I'll be selling a call contract with 100 shares of an underlying asset I already own as collateral. Alternatively, to secure the 100 shares, I can directly buy 100 shares of a stock. As the seller of the call contract, what I'm putting on the table is my obligation to sell 100 shares of this asset to the buyer of the contract at a specified price, strike price, and at any time on or before a specified date, the expiration date. My objective again is to collect the premiums that I receive immediately upon the buyer fulfilling my contract, and for the contract to expire worthless for the buyer, so that I would not need to sacrifice my collateral of 100 shares. I use the covered call when I anticipate the share price to decrease or when I have a bearish outlook on the market. The pros of the covered call are: 1. I will collect premiums no matter if the option goes against my favor and gets exercised. The collected premiums can help me reduce my cost basis. The cons are: 1. I'm obligated to sell 100 shares at the strike price if the contract expires in the money for the buyer, which means that the share price is above strike price. 2. There is a capped profit potential to the covered call. If my shares are assigned, I'll only receive the premiums and profits from the strike price exceeding my cost basis. I can't capitalize on capital gains if the share price surpasses the strike price. 3. I require a lot of capital to own 100 shares. Once more, these are the steps I take when placing a covered call. First, I will choose a stock that I think is likely to trade flat or decline. Second, I will choose a stock that I am not bound to or do not have a lot of capital gains on. This means that I am okay with being assigned and selling my 100 shares away. Third, I will choose a strike price above my cost basis. For example, I will have my strike price at $10 per share if I initially bought at $8 per share. Thus, if my shares are assigned, I would make $2 per share, a total of $200 profit. Choosing a strike price below my cost basis means I'll be taking a loss if my shares are assigned. Fourth, similar to cash-secured put, I will consider delta. Most investors look at a delta of 0.3 or lower. In this case, a delta of 0.3 or lower suggests that the buyer has a 30% probability of the option expiring in the money and a 70% chance of it expiring worthless for them. Fifth, I will also consider the expiration date of my options contract. Like cash-secured put, the most common period investors use is from 30 to 45 days to expiry, DTE. Sixth, when I place my trades, I do not let the premium price influence my strategy, but rather consider it as a bonus. I always focus primarily on my criteria and game plan to maximize rewards and minimize risks. Seventh, I avoid placing covered calls during the week of the share's ex-dividend date. This is because I do not receive dividends if my shares are assigned early during expiration week, as I do not hold the stocks on the ex-dividend date. Eighth, when selecting the strike price, I calculate the break-even price for buyers by adding the premium per share that the buyer needs to pay to the strike price. This tells me the likelihood of my shares being assigned, since they will only be assigned when they reach the break-even level for the buyer. Take note that if my shares are assigned, I'll still need to sell them at the strike price. Moving back to the SPY example, let's assume I bought SPY at $498.10 on the 7th of February 2024. On the 20th of March 2024, I decided to sell a covered call for one lot of SPY with the following terms. The following parameters of this covered call are a strike price of $528, a delta of 0.292, which means a 71% chance of this cash-secured put expiring worthless for the buyer. An expiration date of the 19th of April 2024, with 30 days to expiry from the 20th of March 2024. Once again, there are two outcomes. Firstly, the contract expires out of the money for the buyer if SPY stays below $528. The buyer would not exercise their right to buy SPY at $528 since they can buy it at a cheaper price on the open market. The contract expires worthless, and I get to keep my 100 shares of SPY and the premium. Secondly, the contract expires in the money for the buyer if SPY exceeds $528 plus premiums paid. The buyer would want to exercise their right to buy SPY at a cheaper price than what is in the market. My 100 shares of SPY are assigned at the strike price of $528. I still get to keep the premium.